Hey there. Welcome back to our channel, Annuity Association. I am Jeremiah Conjure, your host, and today we are going to be conducting another unbiased annuity review. Today we're going to be reviewing the Nationwide Peak 10 Fixed Indexed Annuity. This is a very popular annuity. Lately on the marketplace, it's been very competitive from a lifetime income perspective. And it is a limited distribution product, so not all advisors or agents have access to this product. So if you're looking for a way to compare this product, maybe to one that you're already looking at, or you're just kind of wondering what else Nationwide has to offer, and you want to see how this one stacks up against the hundreds of other indexed annuities on the market for lifetime income. And if you'd like to do that and work with us directly, you can visit our website at annuityassociation.com. And right there on the main page, you can request your free annuity discovery, where we'll take you into a deeper dive into understanding the wide world of annuities, how to appropriately apply them to your situation, and compare them in a very transparent and easy to understand way, so that you ultimately can make a better annuity buying decision. And that's what our mission is to help people like yourself make better annuity buying decisions. All right, so without further ado, let's go ahead and get into the presentation. Bear with me while I share my screen here. Hope everyone is having a great day. All right, so we're talking about the Nationwide Peak 10 Fixed Indexed Annuity. 10 just indicates that it's a 10-year surrender period contract. Nationwide is about helping you look to the future with confidence. Before we get started, this material is not a recommendation to buy or sell a financial product or to adopt an investment strategy. Investors should discuss their specific situation with their financial professional. You can receive earnings when the underlying index goes up, but your principal and earnings are also protected from downturns. This means you won't lose principal or earnings based solely on negative index returns. A fixed indexed annuity is not a stock market investment and does not directly participate in any stock or equity investment. A fixed indexed annuity may be appropriate for those who want the opportunity to capture some upside potential while having a level of protection from market downturns. Withdrawals taken before age 59 and a half may incur a 10% early withdrawal federal tax penalty in addition to ordinary income taxes. And withdrawals may trigger surrender charges and market value adjustments and reduce your death benefit in contract value. Please keep in mind that annuities have limitations. They are designed for long-term retirement goals. They are not meant to be used as emergency funds, as income for day-to-day expenses, or to fund short-term savings goals. Federal tax laws are complex and subject to change, and the information in this brochure is based on current interpretations of the law. Nationwide and its representatives do not give legal or tax advice. Please talk with your attorney or tax advisor for answers to specific questions. All right, now that we got that fun stuff out of the way, let's go ahead and dive in. So why Nationwide? Well, they offer guaranteed income backed by the strength of themselves. Nationwide. They are Fortune 100 Best Companies to Work For since 2015 and a Fortune 100 Best Workplaces for Diversity since 2016. They hold a A+ rating from AM Best, an A1 rating from Moody's, and an A+ from Standard & Poor's. And Nationwide is dedicated to service and committed to the community. They are deeply invested in the communities they serve and continue to support efforts to improve the lives and expand the possibilities of its members. Currently, up to this date here in 2023, they have donated up $6.8 million by the Nationwide Foundation to the United Way, $10 million contributed by the Nationwide Foundation to Nationwide Children's Hospital in 2023, $1.5 million contributed to Red Cross disaster relief in 2023, and Nationwide associates donate thousands of units of blood annually. $670 million has been contributed by the Nationwide Foundation since 2000 to help nonprofit organizations and communities where Nationwide associates and their families live and work. and $2.5 million has been contributed by the Nationwide Foundation of Feeding America and other hunger relief agencies in 2023. So they do a lot of good for the community. Market volatility is still on our minds. Nearly 4 in 10 investors are more nervous now about their ability to protect their finances and investments. This is from a study done by the 9th Annual Advisor Authority and by the Nationwide Retirement Institute as of April of 2023. So like all fixed indexed annuities, you have a contractual guarantee of principal protection from down markets. So here is a little image here that they're showing the protection of your principal in a down market. So that blue line there is representing the ebbs and flows of the stock market. And you'll see at any point in time where there was a decline, you have a guarantee of principal protection. So in other words, in the event of a negative year or performance for the markets, your money is going to stay level right where it is. But in addition to that, you can also participate in the upside growth of the markets as well by either having a cap or a participation during those positive years. And that's where the Nationwide Peak 10 Fixed Indexed Annuity comes in. Again, you have a guarantee of principal protection from market risks, growth potential with guarantees, protection for a spouse through their guaranteed income for life rider contract. And so let's talk about protection from market risks. And the main concern is that 61% of the respondents think that there is some possibility of a market crash in the next 6 months. This was from a study held, or a survey rather, by the Yale School of Management for the United States stock market confidence in December of 23. The Nationwide Peak 10, with that product, you're guaranteed not to lose any of your initial investment or credited earnings due to underlying index performance. Guarantees and protections are subject to the claims paying ability of Nationwide Life and Annuity Insurance Company. And also, if you withdraw assets, your principal could be reduced by surrender charges. There is a free withdrawal provision in this contract, which we will cover here momentarily. In addition, if this is the first time you're tuning in, thanks for watching. We're also going to open up our software and take an inside look under the hood of the various indexes and their crediting performance potential, and also a practice exercise on how the lifetime income rider works within this product. Next is the growth potential with guarantees. There are quality investment options available in the Nationwide Peak 10 Fixed Indexed Annuity. These indexes include the AB Growth and Value Balanced Index, the BNP Global H Factor Index, the JP Morgan Cycle Index, the S&P 500 Composite Price Index, and the S&P 500 Daily Risk Control Index. So let's take a look at crediting option 1. This is a 1-year term with a cap or index cap. And this is available on the fixed and indexed options. And so here is an example of what that might look like. The blue lines indicating the ebbs and flows of the index itself according to the markets and how that index is responding. And you're noticing at the bottom there, you're noticing the different policy years. And then on the left there, you're seeing the different percentages of growth. Anytime that performance is positive, you can earn up to the cap. And anytime the performance of the index and market is negative, there is a floor, which you'll see is right there on the 0% line. So the floor being 0%, indicating that you can never incur any negative losses due to negative performance of the index. So if the index grows, you'll receive the growth up to the cap amount. In this example, they're showing a 6% cap. And if the index return is negative, you won't lose money as the index has a floor of 0%. Next would be a crediting option number 2. This is a participation rate with a spread. So let's take a look. Again, the dark blue line representing the ebbs and flows of the index, then the floor there being 0, and then the participation rate showing here as the 70% participation. And so what's happening here is the line, the dark blue line is flowing, and then you'll notice how when you hit that cap, I'm sorry, it looks like the dotted line in this case is actually the market returns, the index returns raw performance, and then the dark blue lines representing the participation rate. So you'll see whatever that dotted line is in those positive years, that dark blue line is representing the 70% participation. If you're not familiar with that term, participation rate is very, very simple. It's simply of the index's raw performance for that crediting period, how much do you participate in as the contract owner? So in this case, if the as an example, if the raw performance of the index was up 10% for that crediting period, and you had a 70% participation, well, the calculation at the end of that contract anniversary would be taking the raw performance of the index, which is 10%, multiplied by the 70% participation. So your contract would therefore be credited 7% interest after factoring in that participation. Now, this strategy also includes a spread. The way that I define a spread is basically like a rake at the casino. If you ever go to the casino and you play cards, you'll notice the dealer always takes a rake off the table, that being, the percentage of the chips that go to the actual house or the casino in this case. And a spread is no different. Whatever the raw performance is multiplied by the participation minus the spread is what the net interest credit would be. So let's go back to that 10% raw performance example. If the index is up 10% and you have a 70% participation, your gross interest credit would be therefore be 7%. And if there's a 1% spread that's part of this strategy, then they would take that 7% gross interest credit minus 1% for the spread. The net interest credit to you would be 6%. And that 1% spread is kept by Nationwide. So there is no spread in negative years or 0 years. So if the index strategy is negative or flat, you would earn a 0 and there would be no spread. The Nationwide in this case only gets the spread if there's positive performance of the index after the participation rate calculation. And let's talk about protection for a spouse. This is the main reason people purchase annuities like the Nationwide Peak 10 is because of the guaranteed lifetime income rider that can be structured for single life or joint life to help cover you and a spouse. And that guaranteed lifetime income will provide an income stream that neither one of you will ever outlive. And there's a significant need in the marketplace today for these guaranteed lifetime income streams. As a matter of fact, based on the research we've conducted, and a lot of that has been done by a lot of the PhD experts in retirement planning, a lot of them unanimously agree, all of them unanimously agree for that matter, that a retirement income plan with a guaranteed lifetime income annuity versus one without a guaranteed lifetime income annuity is far more optimal having it than not having it, for many reasons. The main reason, not just economically speaking, but also psychonomically, the peace of mind and the clarity and the confidence that it provides a couple as they age and move through retirement, that their incomes and their retirement incomes, for that matter, can never be derailed because they're guaranteed for life. And the markets no longer dictate how much income that family can spend because it's not tied to the markets. It's guaranteed. And that's the beauty of it. And when used appropriately, which is what we believe in and what we specialize in, you can create an optimization in your overall portfolio by risking off enough of your assets to provide a foundation of lifetime income, while then allowing you and affording you to take more risk with the remaining assets outside of the annuity to create an optimization so that you get more growth and more income on a guaranteed basis. So the need is here for a 65-year-old couple, there's a 50% chance one of them will live to be 92 years of age. And this is based on the Actuaries Longevity Illustrator, American Academy of Actuaries, and Society of Actuaries. This was assessed on April 15th of 2024. That's a pretty cool tool. If you haven't done so already, you can just Google that, Actuaries Longevity Illustrator. It'll take you right there, and you can plug in your ages, and it'll basically show you the probability based on actuarial science of how old you may live as a single person or joint. And for the Nationwide Peak 10, their guaranteed lifetime income rider does address this concern. And that is the joint option on the death benefit allows the annuity contract owner to name a spouse as a co-annuitant. And this allows the death benefit to be paid to either spouse no matter who passes away first. So what they're referring to here before we get to the guaranteed income element is actually the joint death benefit. So in a fixed indexed annuity, there is an account value that has the ability to grow on a non-guaranteed basis via the index crediting strategies. And whatever monies are there in that account value, that then also can pass on as the death benefit in the contract if the annuitant passes away. So it's a very valuable thing to know here, because one of the biggest misconceptions of annuities is that if you purchase one and you die, the insurance company keeps your money. And that's actually false. There's only one type of annuity structured in one particular way where that would ever be the scenario. But in this type of annuity, that is not the case. And here we are with the guaranteed income for life. The concern there is that only 27% of respondents are very confident they'll have enough money to live comfortably through retirement. And that's where the Nationwide Peak 10 and its guaranteed lifetime income rider addresses that. It allows you a choice of 2 guaranteed income solutions that last as long as you live, even if the contract value falls to 0. Of course, these guarantees and protections are subject to the claims paying ability of Nationwide Life and Annuity Insurance Company. So let's discuss those 2 options. Here we have option 1, the guaranteed income solution. And the illustrations used here contain hypothetical figures and do not represent actual results. Past performance is no guarantee of future performance or of values of indexed life insurance. Different time scenarios will produce varying results, which could be less or more favorable depending on the performance of each entity. Fixed indexed annuities are not stock market investments and do not directly participate in any stock or equity investments. So here they're showing the guaranteed income solution, which is option 1. This is a great option for someone looking for a zero feed income rider. So like I said there, zero feed. There's not any fees for this option. It's going to offer you a 4% guaranteed simple interest rate during the deferral phase. And then once that deferral phase is finished, upon income election, it'll pay out a guaranteed lifetime income stream of whatever that income benefit base has grown to. So here in this example on the bottom there, that they're showing there the years of deferral. And then on the left, they're showing the income benefit value, assuming $100,000 was put in day 1. And then you'll see as each year surpasses during the deferral phase, that blue line is representing the guaranteed growth of that income benefit base amount after the 4% guaranteed simple interest rate has been added and calculated. So that blue line is representing the contract value, and then you'll notice that dotted line is representing that 4% guaranteed simple interest rate. Very easy to understand, very simple. But here is really why this product as of late has been popular. It's because of option 2. They call this the bonus income plus rider. So in this product and this structure of the income rider, or option 2, they're applying a 20% one-time bonus at issue. So day one of contract year one, they're applying a 20% bonus to the income benefit base amount, which is your initial premium investment. And then each year of deferral, instead of 4%, they're doubling that to 8% guaranteed simple interest. Why that's important is because utilizing an income rider like this is a great way to mitigate the sequence of returns risk that we all face during our final working years leading up to when we anticipate retiring. Usually that window is a 10-year period. So if you're planning to retire within a 10-year window, the one thing that we can't control is unfavorable sequence of returns from the markets during that 10 years. Meaning it's not about the average return that your portfolio would earn during that period. It's how those returns unfold each year and what the sequence of those is. Meaning if you had a very unfavorable 10-year window, maybe you had some really big losses in the earlier years, but then you kind of offset them in the latter part of that 10-year window, and your average was, let's say, 5% or 7%. That's great. But those negative years, if they unfold unfavorably, okay, and especially if they're leading up to the final years of when you're getting closer to retirement, if you have some negative losses that are incurred in those final couple years, that can be very detrimental to how much you can retire with and how much income you can retire with as well. So having an income rider product shields you from those unfavorable sequence of returns and allows you to have a lot of confidence and clarity on how that portion of money is going to grow on a guaranteed basis that can then be converted to a lifetime income stream. So very powerful tool when used appropriately. And it just comes down to understanding the application and how to mitigate those risks, which if you're looking for someone that can help you with that, you want to compare this product and how it can be potentially a good fit. Maybe you're working with another agent or advisor. Maybe you've attended an educational workshop or a seminar, and you want to compare this product versus another one. That is what we do. We are an independent annuity advisory firm. We specialize in helping people like you make better annuity buying decisions. And we do that through transparency and education to ultimately help you compare and contrast the available options to determine which product and which annuity is going to give you the best value, both from an economic perspective and a peace of mind perspective. So we want to make sure that we give people the ability to compare. We don't have any allegiance to one product or company. We truly represent you and your best interest first. And we will show you using our softwares an easy way to compare these products so that you can make your own informed decision. And we hope that by being able to help you do that, that you'll purchase those annuities through our firm. And that's how we make our living. So hope that can be of value to you at some point in the future. And if it is, if you're interested in that, you can visit our website at annuityassociation.com. Right there on the main page, click on the annuity discovery button, and you can schedule a hassle-free consultation via Zoom where we can connect with you and take you through that process of evaluation and understanding and comparative analysis. We serve clients in all 50 states. So option 2 here is the ability to take one non-lifetime withdrawal that will not stop your roll-up or lock in the percentage of your lifetime withdrawals. Very cool feature there. Not all annuities offer that. So what they're saying here is that during the deferral phase, if you choose or need to take a non-lifetime withdrawal, you can do that, and it will not stop your roll-up or lock in the percentage of your lifetime withdrawals. Normally, when you elect to turn on any form of income, that roll-up period of that 8% in this example during the deferral phase will stop once you activate income. And then whatever the payout percentage, which is also a contractual element of the income rider contract based on the age of income election, that will lock in. Well, they're saying in this particular product under this option, for the bonus income plus rider. If you need to take a non-lifetime withdrawal, you can do that, and it will not stop the roll-up phase or lock in the percentage of your lifetime withdrawals. There is a joint option here for your spouse, which guarantees that your surviving spouse will continue to receive the same lifetime withdrawals, uninterrupted and for the rest of his or her life. Rates for this feature are based on the age of the younger spouse. So this is a great way to mitigate one of the more difficult challenges in retirement as we age, and that's losing our spouse, losing our loved one. And during that difficult time of mourning, the last thing that we would ever want is for that spouse to have to worry about where their income is going to come from. And this lifetime income rider with the joint option gives you a lot of peace of mind that, God forbid, if something were to happen, that during that difficult time of mourning, your surviving spouse is taken care of, and that paycheck for the lifetime income will continue to come in every single month and every single year. It really also takes a burden off of your children and your loved ones, so that they don't have to worry about your husband or wife and help, in terms of helping them figure out that income equation. That's going to continue paying out no matter what. And so what we've talked about today with the Nationwide Peak 10 Fixed Indexed Annuity is that it offers protection from market risk with those contractual guarantees. You also have growth potential with guarantees, protection for a spouse, and guaranteed income for life, either single or joint. So again, if you're interested in comparing this product side by side to one that you're already considering, maybe you want to compare this one to some of the others. There's hundreds of these types of annuities on the market. We specialize in helping people make better annuity buying decisions, and we'd love the opportunity to work with you. My name is Jeremiah Conger. I am the CEO of Annuity Association. We have a team of advisors that are trained and specialized to serve your best interest and put them first. We do that through a very educational and transparent process. We connect with clients in all 50 states via Zoom. And if you'd like to take the opportunity to speak with us, we would love the opportunity to serve you. You can do that by going to annuityassociation.com, and right there on the main page, there is a way to schedule a hassle-free annuity discovery meeting to see if we can help point you in the right direction. All right, so let's get into our software now. I do have the Peak 10 pulled up here, and what we're going to do is break down the different index crediting strategies in a hypothetical manner to determine which ones may be a better fit potentially to, if your goal is to grow your account value over time during the deferral phase. Remember, the account value is going to be your death benefit. It can also be your liquidity. If you need additional funds, you can access the account value up to 10% per year, which I did say we were going to cover. So let's take a look at that real fast. So this product does have a 10% free withdrawal. It is a 10-year calendar or schedule product. So there is a surrender schedule. If you were to cancel the policy and exit with before the 10 years has been met, there would be a surrender penalty, and that can be seen here. In addition, we have those of different rider options and different indexing accounts. So let's take a look at those options now. So what this software is designed to do, and this is what we use to help us conduct our analysis and comparing these products side by side. The Nationwide Peak 10, so far here, as of today, at the time of this review, the 2-year BNP Global H Factor point-to-point with the participation rate and spread, option A, is coming in as the highest performing back-tested index crediting strategy when looking back over the last 10 calendar years. So over to the right, we're looking at the annual returns, the larger numbers indicating the average return over the last 10 years. The green numbers representing the highest annual return of the best 10 consecutive years out of the last 20 years. And then conversely, the red numbers indicating the lowest rate of return annually for the worst consecutive 10 years over the last 20. So again, these are hypothetical in nature. This is taking the back-tested performance of the index and applying the participation rates and spreads of the offers today. So assuming everything was the same, if you own this product during that time, this is basically indicating what that account value could have possibly grown at. The last 15 years, it shows 16.86%. Now, we don't just believe in hypothetical back-tested returns to make a good decision. We also look at real-time performance of these indexes to see what they've done as of late. So if that's something you'd like to compare and take a deeper dive into, that's something we specialize in, and we'd love that opportunity to speak with you. Taking a look here, there's option B of the 2-year BNP Global H Factor participation rate with the spread. That offers a 300% participation in a 0% spread for this option. So the difference between the two that leads to this change in the annual performance is that option A includes a 1% spread and a higher participation of 325%, and option B has 0 spread and a lower participation at 300%. We also have the 2-year AB growth and value balance point to point with a participation rate with a spread option A, 280% participation and a 1% spread. And then we see how that correlates over here to the back-tested returns. And then again, option B, no spread and a lower participation at 260%. Rounding out the top 3, the JP Morgan Cycle Index with the 2-year point-to-point participation rate with spread option A, 295% participation and a 1% spread. And then we'll see how that translates over here. Again, you're seeing these very high participation rate strategies. The higher the participation rate, normally that's indicative of the volatility controls of these indexes. The more volatility is controlled by the algorithms of these index strategies, the higher the participation rate will be. The lower the participation rate, that usually indicates that the index crediting strategy itself or the index that it's following is very volatile. Therefore, lower participation rates will be offered. And it really comes down to just understanding the logistics and mechanics of these insurance companies and how they're able to offer some of these features and benefits, mainly being that they're buying option placements on these associated indexes. And the more volatile the index is, the less likely those option placements are going to strike, therefore causing the option placements to be less efficient. And that translates to the participation rate and how high it can be offered at. So rule of thumb is the higher the volatility of the index, the lower the participation, because the options are less efficient. All right, so they have a couple other strategies. The S&P 500 daily risk control 5%. That also comes in the 2-year point-to-point with a participation rate and spread, or option B with no spread and a lower participation. We'll see those returns here to the right. They also offer a traditional S&P 500 option, and there we go. That's an indicator that the S&P 500 without the volatility control, just the pure S&P, obviously being a 100% equity-focused index and a very volatile index because of that high equity exposure, the participation rate is low or lower. Still a fair deal, though, at 65%, does have a 1% spread, and you'll see how that translates to the back-tested returns over to the far right. So if you're just an S&P 500 enthusiast, maybe you don't want to get into any of the complications of understanding a volatility controlled index, the S&P 500 is available here in the Nationwide Peak 10. It also is available with a cap strategy. The cap is offered at 7%, and we'll see how that translates over here. So a cap strategy is very simple in any given year. In this case, it's a 1-year point-to-point. whatever the S&P 500 index does from a raw performance perspective, you can earn up to 7% since that is the cap. If the S&P performed at 10%, the most you would get credited is 7. If the S&P went up 5, you get all 5. Okay. All righty, let's go ahead and look at the income rider over here. So as a exercise, we're going to take a look at the Peak 10 income rider, both option A and option 1 and option 2. And so we're just going to put in a hypothetical scenario, person living in Florida, age 61, $100,000 premium going in, looking at a single life male. We'll see how this income rider comes up. So we have both options here on the screen. We have option 2, which is the bonus income rider, and then the guaranteed income solution, which is the option 1 with no fee. The bonus income rider for a single life is 1% a year for that fee. But what we have found in our analysis is that if you're looking for lifetime income, having the fee versus the non-fee version of the income rider far outweighs the cost of the rider because of how much income you're getting on a guaranteed basis versus no fee at all. It's over double. So it makes a lot of sense. And if you really compare it to like the average fee in a 401k or an IRA, even if you're not paying someone to manage it, but you're just keeping it in Fidelity or wherever, the average fees for those programs or those types of products, 401k or IRA, is generally around 1.5%. So when you compare this to that, and the fact that you can get a guaranteed lifetime income stream, which no 401k or IRA can provide, it makes a lot of sense for that fee being 1%, given the fact that you're getting peace of mind and clarity on a lifetime income stream you'll never outlive. And so let's take a look at how this is getting there. So with $100,000 going in this scenario, we're deferring this income stream 4 years. So activating it contract year 5 when this person turns age 65. The $100,000 is growing in the income benefit base value to $158,400. How is it doing that? Well, remember, it has a 20% one-time bonus that's applied day 1 to the income benefit value. And then each year of deferral, so in this case, 4 total years, this income benefit value is growing by 8% simple interest each year. So if you do the calculation, that 100,000 is growing to 158,400 guaranteed. And then when this person activates the income stream, they're going to get that lifetime payout percentage of 6.25%. Very cool. I also like to look at a feature that I call the cash flow of the annuity. And the cash flow is basically a very simple equation. It's the initial premium investment, which is referred to as the premium, and the income, the division of that two. So the income divided by the premium. And in this case, that person, for that 100,000 they're putting in, they're guaranteeing a cash flow from that 100,000 of 9.9% a year for the rest of their lives. And lastly, we have that guaranteed income solution, which is option 1, the no fee version of their income rider. And we'll see it's getting just a 4% simple roll-up rate during those 4 years. And then we'll also notice a big difference here. The payout percentage is significantly less at 4%. So with no bonus being applied and only 4% simple interest roll-up, the 100,000 is growing to 116,000 after 4 years of deferral. And then they're applying a 4% withdrawal rate, which is also contractually guaranteed to equate to $4,640 a year. So if you were to add these two up, or I'm sorry, multiply these two together, it would add up, or total rather, this. So if you were to look at a joint life benefit, let's say this person's wife is 60 Well, the joint life benefit is going to have a lower contractual payout percentage since there's two lives that are being covered. But the 20% bonus is exactly the same for option 2 under the bonus income rider. And the 8% guaranteed simple interest roll-up rate during each year deferral is still the same. We'll notice that with a joint life, the income guarantee is less, even after the same amount of deferral years. It's just a dollar under $8,000 a year, but we'll see the benefit value still at $158,400. But really, the change is the payout percentage. That's going to change when you elect to have joint life versus single life. When you have joint life, it's going to lower that contractually guaranteed payout percentage because, again, Nationwide is knowing and understanding that they're covering two lives. So their probability of paying out for a longer period of time is higher. And then we'll see how that also affects the guaranteed income solution. We actually see that it doesn't change it. It's exactly the same. So whether it's single or joint, that number's the same for the option 1 guaranteed income solution, which is the zero rider fee version of their income rider. If you were to defer it out, let's say you could go out to 10 years, which this product has a guaranteed roll-up period of 10 years. What that means is you can maximize that guaranteed simple interest roll-up rate of 8% each year for a max of 10 years. So if you were 60, wanted to retire at 70, all those 10 years of deferral, that income benefit value is going to grow at a guaranteed 8%. After 10 years, it no longer gets that 8%. And we'll see how that affects the income benefit value. And then what else changes is the payout percentage is higher because that person is older. The income payout percentage is based upon the age of the youngest of the two annuitants in this case at the time of income election. Okay. So if you're looking to compare this product, again, the Nationwide Peak 10 to another product on the market, or you want to compare all the products, the hundreds that are available, we can help you do that. We can do it in a very easy, simple, and transparent way. We're an independent annuity advisory company, and we'd love the opportunity to work with you. You can go to our website at annuityassociation.com. Right there on the main page, schedule your annuity discovery meeting with us. We'll connect with you via Zoom. You can work with us from the comfort of your own living room, and we'll bring the annuity marketplace directly to you and show you how each individual product from each company stacks up against the next to help you get the most value and ultimately help you make a better annuity buying decision. We don't charge any fees for our services. What we hope is that if we're able to earn your trust and your business, that you purchase that annuity through our firm. And that's how we're compensated, is directly from the issuing insurance company. We don't hold an allegiance to any one company or product. We are truly independent. We work with every major insurance company and every major product on the independent annuity marketplace. So if you want to see how one annuity compares to the next, or you're just in the marketplace and you don't know where to start, we'd love the opportunity to work with you, and we'll take you through our process, which will help you compare and ultimately make a better annuity buying decision. Again, this is Jeremiah Conjure with Annuity Association signing off. We appreciate you tuning in. And if you've gotten some value out of this video today, we would really appreciate if you'd give us a thumbs up wherever you're watching this, or a like, and maybe even comment if you have a question, or if you'd like to meet with us. We'd love to hear from you. We appreciate you watching. Like and share this with friends and family so that we can help deliver our mission, and that is helping people make better annuity buying decisions. Again, Jeremiah Conjure with Annuity Association signing off. Hope you have a great day. Take care of one another. Thank you.